We're looking at a huge market puzzle centered on Webull Corporation, ticker BULL.
It's a classic anomaly, the kind of thing that on the surface just makes no sense at all.
Exactly. We have sources detailing these, stellar Q3 earnings, 55% year-over-year revenue growth.
And an adjusted EPS of 7 cents, which just crushed the 2-cent consensus. A fundamental home run by any measure.
Right. But if you were watching the stock, you know the price just cratered. It fell hard, testing historical lows.
And the research suggests this wasn't investors suddenly hating the company. It was something else. It was the market plumbing overriding the actual value.
That's our mission today. We're going to explain the mechanics, specifically options hedging that forced the stock down.
And more importantly, why that same pressure is now set to reverse and create a pretty significant structural buying event.
So let's start there. This selling wasn't speculative. You're saying it was structural, coming from market makers or MS.
That's it. MMs have one job: stay delta neutral. They can't be bullish or bearish. They have to offset any risk they take on instantly.
Okay, so how does that work? Let's get into the nuts and bolts. A retail trader buys a put, betting the stock will fall. The MM is on the other side of that trade.
Correct. The MM sells that put. By doing that, they've just taken on unwanted bullish risk, a positive delta.
An unintentional long position they have to get rid of immediately.
And to do that, they have to establish an equal and opposite position. That means they short sell the underlying stock. That's the source of the pressure.
Wait, so just the act of MMs managing their risk is enough to absorb all the buying that came in from that incredible earnings report?
It is, and it actually gets worse because of something called negative gamma. As the stock price creeps down toward that put strike price, the MM's risk goes up exponentially.
So they have to sell more.
They're forced to sell more stock to stay neutral. It creates this self-fulfilling prophecy, this negative feedback loop that actively suppresses the price.
That brings up a critical question I know you've seen. How can they short sell on that scale without verifying they can borrow the shares?
Right. They operate under the bona fide market-making exemption in Regulation SHO. It's basically a pass that lets them create synthetic shares to provide liquidity.
So they can meet that sudden post-earnings buying enthusiasm by essentially diluting it on the spot.
It effectively pins the price down, prevents it from spiking.
Okay, so that's the coiled spring. The price was hammered down by these mechanics, but now the key is those options have expired. What happens now?
Now comes the unwind. It has to happen. Those contracts are gone, leaving the MMs with these big, naked short positions.
And they are obligated to close them.
They have to buy to cover. This creates a guaranteed block of buying pressure right as the next trading week opens.
So this structural buying is a sure thing. But why should you care if the overall short interest is low, just over 4%?
Because the setup isn't for a classic short squeeze. It's for a potential gamma squeeze. The put-to-call ratio is incredibly bullish, 0.26. And the call open interest is just huge, over 92,000 contracts sitting right above the current price.
So that unwind buying from the MMs acts as the spark. If it pushes the price up toward those key call strikes, like $9.50 or $11.
The whole game flips. The gamma on those calls activates. The MMs, who are short all those calls, are suddenly forced to switch from being price suppressors to aggressive buyers.
They have to chase the rally to hedge their new risk.
And what's more, with the recent shift to T+1 settlement, this whole cycle is compressed. That buying pressure should be sharper and more condensed than we've seen before.
So let's boil this down for you. The price drop was purely mechanical. It was market structure, just overwhelming, fantastic fundamentals.
But when those mechanics reverse, like they just have, they create an equally powerful structural buying force. The stock is finally free to reflect that 55% growth.
It's a great lesson that sometimes the biggest market signals aren't in the headlines, but buried in the plumbing.
Absolutely, the hammer is gone.
So here's the final thought. Given that massive wall of call options, consider how a stock's behavior fundamentally changes when it shifts, almost overnight, from a negative gamma suppression environment to a positive gamma accelerating one. The accelerator is now on.